Hi folks, welcome to a portfolio review at Finominal. Today we're going to look at Franklin Templeton's alternative portfolio. Now, the objective of this portfolio is to provide exposure to alternative strategies and provide diversification benefits for traditional equity bond portfolios. So let's investigate if the portfolio achieves this, and we're going to kick off with a quick holdings analysis. So in this case, we can see the portfolio is comprised of 7 funds and a bit of cash. And 6 of those funds can be considered alternative strategies. One of them, which is the low volatility high dividend index, is simply an equity product. It's also worth mentioning that there's quite a few Franklin products in here in terms of the systematic style premium ETF, which has the highest allocation, the low volatility high dividend index, and so on, and products from associated companies. The total cost for this portfolio is 1%, which makes it quite expensive. Now, from our perspective, we would say an alternative portfolio as this one, which is comprised of merger up, which is supposedly a market neutral strategy, global macro, CTAs, we should simply benchmark to cash. Now, we selected the 1 to 3 months US Treasury bill index as a benchmark index, and we can see that this portfolio has outperformed the Treasury bill index since 2020, albeit with higher volatility and larger drawdowns. Having said this, this is of course only the performance of the current holdings, not the actual track record. But we can go to the fact sheet of this portfolio, and on the second page, we effectively see the track record, right, of this portfolio with all the trades. Now, since inception in 2018, we can see the net return was negative 1.6, right, versus 2.9% for the benchmark that Franklin Templeton has decided on, which is the HFX Global Hedge Fund Index. Stated differently, this portfolio has underperformed quite significantly. Now, going back to the analysis of the current portfolio, we can also see how the holdings have done. And as mentioned, there is 6 alternative strategies and 1 equity fund. We can see here the outperformance over various time periods, 3 years, 5 years, 10 years. And specifically, we can see that, well, there's quite a bit of underperformance, right, versus just T-bills. So from our perspective, this would be a very low benchmark to beat, right? And actually only 3 out of the 6 alternative funds have managed to generate a higher return than T-bills. The other 3 underperformed. And we can also see that the equity product, which is the low volatility high dividend index, underperformed the S&P 500 quite significantly over the last 5 years. Now, so that's kind of interesting to think about. Naturally, we should be forward-looking, right? And so I guess Franklin Templeton hopefully has the expectation that almost all of those products beat T-bills going forward. Now, next, we're going to want a quick factor exposure analysis, where we're going to primarily focus on the exposure to asset classes. So here we see a returns-based factor exposure analysis, and we can see the betas to the major asset classes over time. Now, what we do note is that there's a consistently positive exposure to the S&P 500. We can see there's a beta of 0.2, which is, well, has been there throughout the last, 5 years or 4 years. We also do see there's a consistent positive exposure to commodities and time-varying exposure to bonds and the US dollar. Now, the exposure to the S&P 500 is not great because this is supposed to be alternative. But if you have exposure to the S&P 500, right, that indicates that diversification benefits might be lower than expected. We can also look at this portfolio from a risk perspective. There's a couple of things that are worth highlighting. One is if you look at the kind of like the portfolio in terms of which of the holdings contributes most from a risk perspective, we do see all through the systematic style premium ETF has the largest weight in the portfolio, 25%. it contributes 26% of the risk, but we see that equity product in here, the low volatility high dividend index, which has only 10% weight, actually contributes 24% to the risk. So that's something keep in the back of your mind, right? That there's a big difference between weights and the contribution risk. We can also do a quick drawdown analysis. In this case, I'm going to compare this to the S&P 500, just as to see, how this would have done to the overall stock market. And we do see that we have 4 or 5 years of history here, right? And if we look at the performance during the COVID-19 crisis during 2020, let me just go back to that tab over here. We see that, the portfolio naturally decreased less than the stock market, but it still had a close to 10% drawdown. And that's not really what you want to see in an alternatives portfolio, because the point of an alternative portfolio is to diversify, to provide positive returns when the stock market was down, which it clearly didn't do during the COVID crisis. Having said that, it did do much better during the 2022 correction of equity and bond markets, right? Where the portfolio lost far less. So that kind of is more attractive. We can also look at the diversification benefits for the portfolio and have a quick look at the kind of correlation to the S&P 500 and bonds. Now the portfolio doesn't correlate very highly to the US aggregate bond index, but it features a correlation of 0.64 to the S&P 500, as we saw earlier, right, reflected in the beta. And again, that's not great, right? What you would want to see from an alternatives portfolio is a correlation, close to 0, effectively, because then naturally you can harvest diversification benefits when you need them. Finally, we're going to have a quick think if we can simplify this portfolio. As mentioned, it contains 7 funds and is expensive at 1%. And we kind of know that in this portfolio, we have a bit of equity exposure with some managed futures and a lot of products that are kind of have returns similar to T-bills. So what we created is a very simple portfolio comprised of global equities. This is just EuroTH, the MSCI World Index, with I think a 15% allocation. CTAs, where we use DBMF, which effectively tracks CTAs with a 25% allocation, and the Western T-bills. And we can see that the correlation of our replication portfolio to Franklin Templeton's alternative portfolio is 0.68. Both of those have a similar correlation to equities and no correlation to bonds, right? So they have a similar nature. We can see naturally from a trend perspective, they're quite comparable. Having said that, the performance of the replication portfolio has been superior. And if you look at this from a Sharpe ratio perspective, right, we can see the volatility, of the replication portfolio was actually lower. The Sharpe was almost 3 times higher with 0.63 compared to 0.19. And as mentioned, the cost is 33 basis points versus 1% for Franklin Templeton alternative portfolio. And this concludes our short analysis of this alternative portfolio from Franklin Templeton. There are some funds in here that are diversifying, like the managed futures one, but lots of strategies like the merger arbitrage, which doesn't really diversify when you need it, the low volatility, high dividend equity product that does not belong in an alternatives product. And so it's fairly easy to build a replication portfolio that gives you more attractive features and is significantly cheaper. Hope that helps. Have a nice day.